Harbour Energy's latest results support a provisional answer. Its operating base has improved, but the size of the cash jump is not yet a new normal. On 6 August, shares rose 6.5% to 247.24p after record first-half production of 509,000 barrels of oil equivalent a day, a higher 2026 free cash flow forecast of $1.8 billion from $1.4 billion, and a new $250 million buyback. The unresolved question is whether that cash reflects a durable change in Harbour's earning capacity or a temporary energy price windfall arriving at exactly the right moment. Before the results, one UK investor analysis treated Harbour as a difficult valuation rather than a simple bargain. It noted analyst targets spanning 220p to 425p, linked the oil and gas price surge to the blocked Strait of Hormuz, and pointed out that around 30% of production comes from UK waters, where the effective tax rate is 78%. The prior reading was therefore clear. Impressive earnings can be real, yet the earnings multiple remains hostage to prices and tax. The mechanics of today's surprise are straightforward. Harbour's log acquisition and strong Norwegian performance raised volumes. Higher realized oil and European gas prices increased the value of each unit. Together, those effects lifted revenue and cash flow. Management says its 5 core countries now account for 85 to 90% of production, reserves, and resources, with a portfolio increasingly weighted towards lower-cost, lower-tax basins.
That is more than a commodity price chart. More production and a reshaped portfolio can reduce Harbour's exposure to declining UK output, but the strongest evidence still comes from management's account, rather than from a full cycle of independently observed results. The cash is already reaching the balance sheet and shareholders. Harbour reported net debt of $5.4 billion and leverage of 0.7 times, while the stronger outlook supported faster debt reduction, a $250 million buyback, and at least $800 million of planned 2026 distributions. Yet, first-half cash flow benefited from tax payment timing. Second-half cash taxes are expected to be about 60% higher, and production is expected to fall because of planned maintenance and possible hurricane disruption. The interim dividend also fell to 8.05 cents from 13.19 cents, so the buyback is not proof that every part of the distribution picture has improved. There is a second reading, though. Harbour may be moving beyond a short-lived shock. Dvalin North started ahead of schedule and under budget. Norwegian development activity has accelerated, and management is targeting U.S. production of 65,000 to 70,000 barrels of oil equivalent a day by 2028. It also expects to invest $2 billion to $2.3 billion a year from 2027, while supporting production of 475,000 to 500,000 barrels a day through the end of the decade. If delivered, that would represent a more durable operating base.
For now, those are forecasts and project milestones, not established cash flows. The alternative explanation remains powerful. Commodity prices surged because of war-related supply disruption, and Harbour benefited despite having no direct Persian Gulf exposure. The company has chosen to keep capital spending unchanged while prioritizing debt reduction and shareholder returns, which protects near-term cash but leaves the longer-term production case dependent on execution. The useful checkpoint is operational rather than purely financial. Harbour expects Zama engineering tender shortly and a preliminary floating production agreement by the end of the month, with final investment decision readiness targeted by the end of 2027. Progress on those milestones, alongside sustained production and cash guidance, would strengthen the structural interpretation. Delays combined with normalizing energy prices would make the windfall interpretation more convincing. The strongest current judgment is that Harbour is a stronger operator temporarily amplified by an unusually favorable price environment, not yet a permanently higher cash flow machine. The production improvement and portfolio reshaping are real in the reported figures, but the persistence of the cash generation remains unresolved. The evidence does not establish where oil and gas prices will settle, or whether every project will meet its timetable.